Disclaimer, 72 hours. That's approximately how long it took for Silicon Valley Bank to collapse in March 2023, from solvent to gone. And according to recent Federal Reserve data, there are reportedly around 186 banks in America right now sitting on the exact same powder keg. Not struggling banks, not small regional institutions, major banks, banks you probably use, banks holding an estimated $685 billion in unrealized losses according to FDIC reports. That's not a typo. $685 billion. And here's what they're not telling you. These losses aren't hidden in some complex derivative trade. They're sitting right there on the balance sheet in plain sight. In something so boring, so safe, so trusted that nobody's paying attention, US Treasury bonds. I'll show you exactly how this works and why it's arguably worse than 2008. First, you need to understand the impossible math that's breaking the system right now. January 2026, the Federal Reserve holds rates at approximately 4.5%. And everything is already fracturing. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Right now, right this second, America's banking system is reportedly facing what some analysts call a liquidity time bomb. Not a credit crisis, not a mortgage meltdown, something potentially more dangerous, a duration mismatch crisis hiding in plain sight. Here's what that means. Your local bank takes your deposit, let's say $100,000. They pay you approximately 0.5% interest on your savings account, according to recent national averages. Maybe 4% if you're lucky enough to have a high yield account. Then they take that money and buy a 10-year Treasury bond, yielding around 1.5%. That was 2021. Safe, steady, guaranteed by the US government. The ultimate low-risk asset. Except something changed. The Fed hiked rates from approximately 0% in 2021 to around 5.5% by 2023, according to Federal Reserve data. The fastest rate increase in roughly 40 years. And when rates go up, bond prices go down. It's inverse. Always. No exceptions. That 10-year Treasury the bank bought at around 1.5% yield, it's now worth approximately 15 to 20% less, according to bond market pricing. The bank didn't lose money. Not technically. Not on paper. As long as they hold to maturity, they get their principal back. But here's the trap. What if depositors want their money? What if there's a run? What if customers start pulling deposits because they can get 5% in a money market fund instead of 0.5% at the bank? The bank has to sell those bonds at a loss. A massive, crushing, potentially devastating loss. Silicon Valley Bank reportedly held around $21 billion in Treasury and mortgage-backed securities. When depositors panicked and withdrew an estimated $42 billion in a single day, SVB had to sell, at losses approaching $1.8 billion, according to reports. The bank collapsed in approximately 72 hours. March 10th, 2023. SVB goes under. March 12th, Signature Bank fails. March 19th, Credit Suisse nearly implodes, requiring a shotgun merger with UBS. 3 major financial institutions gone, or restructured in 9 days. Most people think the crisis ended. It didn't. It just went quiet. Let me show you what happens when the banking system faces a liquidity crisis. Because this has happened twice before in modern American history. And both times, it didn't just hurt banks. It devastated the entire economy. October 1929, the stock market crashes. But that's not what killed the economy. What killed it was what came next. Bank runs. Approximately 9,000 banks failed between 1930 and 1933, according to economic historians. Not because they made bad loans, not because they were reckless, because depositors panicked. They wanted their money, all at once. The banks didn't have it. Liquidity evaporated. Life savings gone. Businesses couldn't make payroll. The money supply contracted by roughly 1/3. The Great Depression wasn't just a stock market crash. It was a banking system collapse disguised as an economic downturn. Unemployment hit approximately 25%. It took a decade and a world war to recover. Fast forward to September 2008. Lehman Brothers files for bankruptcy. Bear Stearns gone. Merrill Lynch emergency sale to Bank of America. Washington Mutual fails. Reportedly the largest bank failure in U.S. history at the time. Wachovia nearly collapses. But here's what most people don't understand about 2008. The crisis wasn't just subprime mortgages. It was a liquidity freeze. Banks stopped trusting each other. The overnight lending market, the LIBOR system that keeps banks funded, froze completely. Banks were solvent on paper, but couldn't access cash. The entire global financial system nearly imploded in approximately 72 hours. The Fed had to inject an estimated $7.7 trillion, according to Bloomberg investigations. Not loans, emergency liquidity. Because when trust evaporates, when liquidity disappears, solvency doesn't matter. You're dead either way. Now here's where it gets terrifying. What's happening in 2025 and 2026 could make both those periods look manageable. Because this time, the crisis isn't in subprime loans or stock speculation. It's in the safest asset on earth, US Treasury bonds. And there's no bailout big enough to fix this. Let's get specific. Recent FDIC data suggests American banks are reportedly sitting on approximately $685 billion in unrealized losses as of Q3 2024. That's unrealized, meaning they haven't sold yet, meaning it's not officially a loss until it is. Break that down by institution. According to various analyst reports and regulatory filings, some of America's largest banks hold treasury and mortgage-backed securities portfolios with embedded losses in the billions. Bank of America reportedly around $131 billion in unrealized losses. JP Morgan approximately $78 billion. Citigroup estimated around $42 billion. These aren't tiny regional banks. These are systemically important financial institutions. And here's the part that should concern everyone. Deposits are fleeing. According to Federal Reserve data, U.S. bank deposits have reportedly declined by approximately $1 trillion from their peak in 2022. Where's that money going? Money market funds, treasury bills, anything paying more than the 0.5% banks offer on savings accounts. Industry analysts point to this trend. As rates stay elevated, as depositors realize they can get 5% risk-free in a money market fund, the slow bleed continues. And every dollar that leaves forces banks closer to the edge, closer to having to sell those underwater bonds, closer to realizing those losses. Recent surveys of regional and community banks suggest some institutions report deposit outflows of approximately 10 to 15%, according to banking trade publications. That's not a crisis yet, but it's a fuse, a slow-burning fuse attached to $685 billion in unrealized losses. Now here's what makes this arguably more dangerous than 2008. Back then, the problem was bad assets, subprime mortgages that were worthless. The Fed could buy them, warehouse them, wait for housing to recover. This time, the assets are good. US Treasuries are going to pay back. The problem is timing. The problem is duration. The problem is liquidity. And there's no bailout for a duration mismatch. The Fed can't just buy every underwater treasury on every bank's balance sheet. That would reportedly require trillions. It would potentially signal a loss of confidence in the entire treasury market. It would possibly trigger the exact panic they're trying to prevent. So the Fed is trapped. Completely, utterly mathematically trapped. Cut rates to help banks, risk reigniting inflation that's still reportedly around 3% according to recent data. Hold rates steady. Watch the slow bleed of deposits continue until something breaks. There is no easy escape, only impossible choices. And here's the signal everyone's missing. For approximately the last 18 months, commercial real estate loans have been deteriorating according to banking industry reports. Office buildings sitting empty. Vacancy rates in major cities reportedly approaching 20 to 30% in some markets. Property values down an estimated 30 to 40% according to real estate analysts. Banks hold around $2.7 trillion in commercial real estate loans according to Federal Reserve data. A significant portion reportedly coming due between 2024 and 2026. When those loans mature, when building owners can't refinance because the property isn't worth what they borrowed, banks face a choice. Extend and pretend or foreclose and realize losses. Small and mid-sized banks reportedly hold approximately 70% of all commercial real estate loans according to industry estimates. These aren't institutions with $131 billion cushions like Bank of America. These are regional banks with thin capital buffers operating in a high-rate environment with underwater bond portfolios and commercial real estate exposure. New York Community Bancorp, January 2024. Announced approximately $2.4 billion in losses tied largely to commercial real estate according to reports. Stock crashed roughly 60% in days. Emergency capital raise, not a failure, but a warning shot. This isn't just investing. This looks like contagion risk. Risk that's been building quietly while everyone focused on inflation and rate cuts and soft landings. The foundation's cracking. Most people just can't see it yet. So let's get tactical. What happens next? What are the scenarios? And how do you position for what could be coming? Scenario 1. The Fed pivots, cuts rates aggressively in 2026. Banks breathe easier as their bond portfolios recover value. The unrealized losses shrink. The crisis is averted. This is the soft landing everyone hopes for. But here's the problem. Inflation is reportedly still around 3%. Recent data suggests core inflation remains sticky. If the Fed cuts aggressively, if they prioritize bank health over price stability, inflation could potentially reignite. And then they're trapped again. Cut rates and fuel inflation or hold steady and watch banks slowly bleed. Scenario 2. The Fed holds steady. Rates stay elevated at approximately 4 to 5% for the foreseeable future. Banks continue the slow bleed of deposits. Unrealized losses remain unrealized until something triggers a run. A commercial real estate default, a regional bank failure, a headline that sparks panic, And then it's 2023 all over again. Except this time, there are reportedly 186 banks sitting on the same powder keg as Silicon Valley Bank, according to analyst estimates. One spark. That's all it takes. Scenario 3. Something breaks that nobody's watching. A foreign bank with dollar exposure, a hedge fund with leveraged treasury positions, a liquidity crisis in a corner of the market that seems unrelated until suddenly it's systemic. Financial history suggests this is how crises actually unfold, not from the obvious risk everyone's watching. From the hidden leverage nobody saw coming, long-term capital management in 1998, AIG in 2008, Archegos in 2021, the pattern repeats. Now here's what smart money appears to be doing. Not panicking, not running to cash, but repositioning. According to recent 13F filings and institutional reports, some major investors have reportedly been increasing allocations to short duration assets, treasury bills instead of 10-year notes, money market funds, physical gold. Industry commentary from analysts at firms like Bridgewater and GMO suggests concerns about financial system stability and bank health remain elevated despite surface calm. This isn't conspiracy theory. This is pattern recognition from people managing billions. January 2026. American banks reportedly sitting on approximately $685 billion in unrealized losses. Deposits down an estimated $1 trillion from peak. Commercial real estate loans approaching $2.7 trillion with significant maturities in the next 24 months. The Fed trapped between inflation and financial stability. This is not just analysis. This is pattern recognition. The 1930s showed us what happens when banks face liquidity runs. 2008 showed us what happens when the financial system freezes. And now we're watching a slow-motion version potentially playing out, hidden in treasury bonds, masked by unrealized losses, building pressure like water behind a cracking dam. Most analysts suggest the system holds. The Fed manages it. Banks muddle through. And maybe they're right. Maybe this time really is different. But what if it's not? What if we're in the quiet period before the storm? The calm that people mistake for safety? Silicon Valley Bank went from solvent to gone in approximately 72 hours. When confidence breaks, when liquidity disappears, when depositors panic, the math doesn't matter. The balance sheet doesn't matter. Only speed matters. And by the time you see it, it's already too late. You have a choice. Assume the experts have it handled and everything works out. Or understand the pattern, recognize the risk, and position accordingly. Because if this really is a liquidity time bomb, if those $685 billion in unrealized losses become realized, if something triggers the next wave of bank failures, this could be the moment you'll look back on. Hit subscribe right now. The next video breaks down exactly which banks are most exposed, which assets could protect you if this unfolds, and what the warning signs look like before the crowd realizes. The banking crisis didn't end in 2023. It just went underground. And what's buried doesn't stay buried forever. The question isn't whether America's money system is broken. The question is whether you'll be ready when everyone else finally figures it out.